Assalamualaikum to Dr. Azazarina. So today me and my group members will present about basic accounting concept. So my name is Izzati Azara.
My name is Kyrene or Emilia.
And my name is Pavitra Naigi.
So we need to choose 8 accounting concept. So the first accounting concept is economy entity, which it means that the business or the firm and the owner of the company are known as two different entities, which this can be explained further in terms of the assets of both entity, which is the company and the owner's personal asset cannot be combined together. So as example, the personal asset of Ali, which is his personal property, is different asset and cannot be combined together in the company, which is Kedai Ali Assets account. So second concept is money measurement, which it refers as to all transaction that is used in the business are to be recorded if it can be expressed in terms of money. So to make it more clearly, the example here explains that if Ali opens a shop, which is Kedai Ali, every transaction that happens in the business must be recorded. However, the transaction included must be in terms of money like salary and income, expenses, and so on. So terms that cannot be included such as employee skills and many more, which is not referred as money. Thirdly is the prudence or conservatism. So where it refers to every amount of transaction in the company must be recorded correctly. So in which the assets and income of the company cannot overstated, while expenses and losses cannot understated. In example, Ali bought inventory for 215 ringgit 90 cent, and the amount of the inventory must be recorded as the same amount that he bought, and it cannot be overstated, which is if the amount is 215 and 90 cents, so Ali cannot overstate it even 1 cent. So I'll be passing next to my friend.
Okay, so I'm going to present for this concept. So I choose a going concern concept. So going concern concept is the business will continue to operate in the foreseeable future. Therefore, the business is not expected to be closed in a short period of time. It means that the going concept is a fundamental principle of accounting. This concept states that a business firm will continue to carry on its activities for an indefinite period of time. It plays a significant role in the way assets are treated. So let's look at the example, such as a company assume that their business will continue for an indefinite period of time and it will last long enough to fulfill their objective or their commitment. Simply stated that it means that every business entity has continuity of life. Therefore, it will not be dissolved in the near future. This is an important assumption for accounting as it provides a basis of showing the value assets in the balance sheet. Okay, next we're moving forward to the consistency. Okay, so consistency refers to when a company wants to adopt an accounting method, it must be applied consistently in the future. So in this case, the principle states that companies should choose a set of methods and use them from one period to the next. The sole purpose of this consistency principle or consistency concept is to ensure that transaction or event are recorded in the same way from one accounting year to the next. Okay, as example, if the company use the straight line method, they should not be changed to adopt reducing balance method in another period. Okay, for consistency concept, a change in the method of accounting for inventory would violate the consistency principle. However, certain changes are permitted with sufficient disclosure regarding the change. Okay, next, we move forwards to the accruals or machines concept. So accounting is an accounting method where revenue or expenses are recorded when a transaction occurs versus when payment is received or made. So in this case, this concept is to calculate the profit for the period. One must include all the revenue and spending relating to the period, whether or not the cash has been received or paid. This concept also states that income and expenses should be matched against each other within an accounting period as far as possible. Okay, so for example, account receivable are the funds that customer owe your company for products or service that have been invoiced, while accounts payable are amounts due to suppliers for goods or service received that have not yet been paid for. Okay, so the next one is my friend is going to present about it.
All right, thank you, Amelia. So now I'm going to explain about the seventh basic concept of accounting, and it is historical cost. So as stated in the infographic, historical cost is an asset should be shown on the balance sheet at the cost of purchase at its original cost instead of current value. So for example, if a company's main headquarters, including the land and building, was purchased for 100,000 in 1925, and its expected market value today is 20 million, and the asset is still recorded on the balance sheet at 100,000. If they purchase an item in like very long time, and the price is as stated in the example is 100,000, means it will be stated as 100,000 and it won't change. So this is the example for historical cost. And the eighth basic concept is materiality. So materiality is an accounting principle which states that all items that are reasonably likely to impact investors' decision making must be recorded or reported in detail in a business financial statement using GAAP standards. For example, payments such as postage, stationery, and cleaning expenses should not be disclosed separately. They should be grouped together as sundry expenses. There's stationery called as pencil, razor, ruler. So this all is stated in one accounting concept. So that's called materiality, and that's all from me. Thank you.
Okay, that's all from us. Thank you, madam.